What you're witnessing right now is definitely not a normal market move. This is not a healthy pullback. This is not profit-taking. This is exactly what a financial system looks like when it is starved for oxygen. One of the most violent trading sessions in the modern history of precious metals has just unfolded, and if you are staring at your screen, you already feel it in your gut. Red everywhere. Paper prices collapsing faster than reason can explain. Silver didn't just fall. It was thrown off a cliff. In a single session, over 8% erased a tamp so aggressive it forces even seasoned stackers to pause and reevaluate their assumptions. Gold followed suit. And that is the part most people are underestimating. Gold does not behave like this in a functioning market. A 3.5% drop in what is considered the ultimate store of wealth is not a coincidence. When gold and silver dump together with this level of violence, you are not looking at weakness in metals. You are looking at stress in the plumbing of the financial system itself. This is what happens when liquidity vanishes. In moments like this, institutions stop thinking about value. They stop thinking about long-term theses. They think about one thing only: survival. Bills must be paid. Margin calls must be met. Cash becomes king, not because it is strong, but because it is required. Assets are sold, not because they are bad, but because they are liquid. Gold and silver are among the last assets that can still be converted into fiat instantly globally at scale. That is the reason they are hit first and hardest. This is not retail panic. Retail stackers do not unload billions in seconds. This is institutional distress. Somewhere deep in the system, something broke. A leveraged position failed. A margin threshold was crossed. And once that happens, the selling is no longer emotional. It is mechanical, relentless, unforgiving. In this emergency analysis, we are not here to tell you to buy. We are not here to tell you to sell. We are here to explain the rigged machine, because understanding what is happening is the only way to stay clear-headed when volatility is designed to strip that away from you. This is the anatomy of a liquidity event, and it has only just begun. If you want to understand what comes next, you have to understand exactly why this had to happen. To understand why this price collapse happened so fast, you need to understand a rule that governs every leveraged market on Earth. When margin calls arrive, investors do not sell what they want, they sell what they can. This distinction is everything. It explains why assets with strong fundamentals can fall harder than assets with weak ones, and why logic seems to disappear exactly when you need it most. Imagine a large institutional player, not a reckless gambler, but a diversified fund with positions across stocks, bonds, currencies, and commodities. Everything looks stable until one corner of the portfolio breaks. Maybe bond yields spike. Maybe a currency trade moves violently. Suddenly the phone rings. The broker is not asking for explanations. They are asking for cash. Billions of fiat dollars today. At that moment, theory dies. Long-term outlooks are irrelevant. The fund looks at its holdings and realizes the problem. Bonds cannot be sold without collapsing the price further. Private equity is locked up. Illiquid assets are useless in a crisis. But physical gold and silver, those trade around the clock. Deep markets, global buyers, instant settlement. So the decision is made not because it is smart, but because it is necessary. The sell button gets hit, hard. Massive blocks of paper metal are dumped into the market in seconds, not to exit a trade, but to raise cash to save everything else. This is why the drop in gold matters more than the drop in silver. Gold is the last line of defense. You only sell it when everything else has failed. Silver, being a smaller and more volatile market, absorbs that shock like a thin sheet of glass. The same force that pushes gold down 3% pushes silver down 8%. This is not a judgment on silver's future. It is a reflection of its role in the liquidity hierarchy. Nothing about industrial demand changed today. Solar panels did not stop being built. Batteries did not stop needing silver. What disappeared was liquidity. And when liquidity disappears, spot price becomes a casualty. This is how a margin cascade begins, and once it starts, it feeds on itself. In the next short chapter, we need to examine why gold selling is the most dangerous signal of all, and what it is quietly telling us about the broader financial system. Silver draws wild attention because it moves fast, but gold is the signal professionals fear the most. When gold drops sharply in a single session, it is never random. Gold sits at the top of the collateral hierarchy. It is sold only when stress has reached a critical level. A move of this size tells us the problem is systemic, not isolated. Gold is a multi-trillion-dollar market. You do not move it 3% in hours because of opinion. You move it because someone is truly forced. This is high-quality collateral being liquidated under pressure. It is the sound of leverage snapping. The pressure point is not silver, it is bonds. Bonds are the backbone of the financial system. They secure loans, derivatives, and balance sheets. When bond prices fall and yields spike, collateral values collapse. Banks react instantly. Margin requirements rise. Hard cash is demanded. If the borrower does not have cash, they sell what they can. And when gold is sold, the algorithms respond. Gold and silver are linked across countless trading systems. When gold breaks, silver is automatically dragged lower. This has nothing to do with industrial demand. It is a pure mechanical contagion. This is why today feels so unjust to metal stackers. You can be right on fundamentals and still suffer from a failure elsewhere in the system, but there is a crucial lesson here. Liquidity crises cannot persist. The system is too leveraged. Every modern crisis ends the same way: intervention. Liquidity is injected, fiat dollars return, and the assets sold hardest are the first to rebound. We are still in the shock phase. Fear dominates, but this phase always passes. Next, we need to examine how algorithmic trading accelerates these collapses and why paper prices often fall far below reality before stabilizing. Modern markets are no longer driven by humans, they are driven by code. And when volatility reaches a certain threshold, that code becomes the accelerant that turns a sell-off into a total freefall. What you witnessed today was not panic selling. It was algorithmic liquidation. For weeks, the trend in silver was way up. Trend-following funds, CTAs, and momentum models were heavily long. These systems do not analyze supply shortages or industrial demand. They follow price volatility and moving averages. As long as the trend holds, they buy. They amplify the upside. But today the structure broke. The drop was sharp enough to trigger short-term trend reversals. In minutes, models flipped from long to neutral, and in some cases from neutral to short. Billions of dollars in paper contracts were dumped automatically. No emotion, no discretion, just cold execution. This is why spot price often overshoots during liquidity events. The algorithms do not know silver is scarce. They do not know premiums are rising. They only know a line on a chart was crossed. This creates forced selling far below fair value. Humans trade reality. Algorithms trade math. In the short term, math has more money. That is why these moves feel so violent and irrational, but this imbalance also plants the seeds of the big reversal. As spot price collapses, physical buyers step in. Arbitrage appears. The gap between paper price and real-world demand widens. This is where the algorithm loses its edge. It cannot see the physical floor forming underneath the market. The crash cleans out leverage. It removes weak hands. It resets positioning. This is painful, but it is also necessary. Before a trend can continue, paper excess must be purged. In the next chapter, we will examine the physical market response dealer premiums and why paper price collapses often fail to reflect real-world scarcity. One of the most misunderstood aspects of this crash is the illusion of price. What you see on the screen is not the price of silver in the real world. It is the price of a paper contract being liquidated by a distressed system. And during liquidity events, the paper market and the physical market begin to totally separate. When futures contracts are dumped in size, spot price collapses instantly. But physical metal doesn't move at the speed of an algorithm. Coins, bars, and industrial supply chains operate in the real world with inventory constraints, transport delays, and fabrication costs. These realities do not disappear just because a hedge fund needed quick cash. This is why premiums matter more than spot during moments like this. When spot drops 8%, but dealer premiums barely move, the market is sending a message. Physical supply is tight. Dealers cannot restock at the paper price. Refiners are charging more, not less. The spread just widens. In a truly healthy market, premiums compress. In a stressed market, they expand. A wide premium is a symptom of a broken pricing mechanism. It tells you the futures market is disconnected from physical reality. Paper is being sold faster than metal can be sourced. This divergence is not bearish. It is deeply structural. It signals that forced sellers are being absorbed by long-term holders and industrial buyers. The weaker the paper price becomes relative to physical demand, the stronger the rebound potential grows. If you hold physical metal, nothing fundamental has changed. You do not face a margin call. You are not forced to act. Time is clearly on your side. The distressed seller must transact now. You do not. Next, we analyze historical paper, liquidity crunches, and the chaos. After forced margin selling ends, using past cycles to frame what lies ahead for true stackers. Paper market crashes feel unique when you are in the thick of it, but history reveals a familiar script. The catalyst shifts, the debt grows bigger, but the rig remains the same. Margin calls drive extreme dislocations, and once that paper selling exhausts itself, the real price snapback is truly explosive. Back in March of 2020, silver spot prices crashed nearly 30% in days. Not because stacking stopped, but because the system craved fiat dollars. Funds dumped paper silver to cover margin calls elsewhere. At the lows, the fear was palpable, yet quickly the metal more than doubled as the Fed printed massive liquidity back into the mix. The same pattern played out in 2008. Gold and silver were liquidated for cash even as the banking system was breaking. Once the Fed stepped in to print, those hard assets became the prime winners of monetary inflation. Liquidity crunches end not with real stability, but with massive stimulus. That is why the most risky time is not the peak, but the middle of the paper smash. This is where weak hands abandon their stacks out of pure panic. They sell real money to hold fiat currency. When the liquidity flows back, they get left behind. History never promises instant relief. Volatility clusters here. Big tamps are often followed by more wild swings, but the past does offer perspective. These drops are sharp and short-lived because prolonged deflation would implode the entire debt-based fiat system. The market is not doubting silver's true value. It is screaming for cash. Once that margin call is met, focus shifts back to hard fundamentals, and supply deficits do not reset in one session. Next, we will analyze where the spot price may attempt to find a solid floor, and which lines matter most for judging whether this is a standard correction or something much deeper. After a smash this violent, the most vital question becomes unavoidable now. Where does the paper dumping stop? In normal times, value creates support. In a liquidity flush, support forms only when forced sellers tap out and physical whales finally step in. The technical chart looks broken, but it is not useless. The first key zone is psychological. Round numbers matter because humans and HFT algos react to them. For silver, this area aligns with the old breakout zone where momentum first accelerated and where stacking demand previously proved itself. Spot price often returns to these levels to test if real conviction still exists. If spot stabilizes here, it suggests the drop was a purge, not a failure. A violent retest after a breakout is scary, but technically healthy. It clears out leverage reset sentiment and forces the market to rebuild on proven, stronger hands. If that level fails, the next support lies deeper, near the origin of the prior rally. A move there would feel catastrophic emotionally, but in highly volatile hard assets, deep retracements are not abnormal. They are part of the cost of participating in markets that overshoot in both directions often. What counts most is not the lowest tick, but the action around support. Rising volume on stabilization, slowing, downside momentum, and price acceptance signal that smart money is stepping in. Continued silence from the buyers signals that the liquidation is not finished. At the same time, physical stacking acts as an invisible floor. As spot drops, arbitrage opportunities grow. The gap between global demand and paper pricing tightens like a stretched cord. Eventually, that market tension snaps back. Next, we must examine how silver miners and equities respond to this stress, and why stock price crashes often misrepresent their underlying profitability. When silver spot drops sharply, mining stocks almost always fall harder. This is where many investors panic, because equity prices feel more permanent than commodity moves. A 10 to 15% decline in miners looks like a verdict, but price action and business reality are not the same thing, especially during these liquidity events. Mining stocks are leveraged instruments. They amplify both upside and downside. When silver rises, margins expand quickly. When silver falls, fear expands even faster. Investors sell miners not because the companies are failing, but because they are selling everything that carries risk. This is truly indiscriminate liquidation. Step back from the charts and look at the numbers. Even at significantly lower silver prices, most primary producers remain highly profitable. Their cost structures do not change overnight. Energy contracts, labor agreements, and capital investments are fixed on longer timelines. A one-day spot collapse does not erase their operating margins. Yet the stock market prices these companies as if the commodity collapse is permanent. This creates a disconnect. Earnings power remains intact while equity prices implode. That valuation gap is not sustainable. Liquidity-driven sell-offs punish miners more than the metal itself because stocks are easier to dump. But once selling pressure fades, equities tend to rebound faster. Investors rediscover cash flow. Valuations compress into absurd territory. Value buyers step in not because sentiment has improved, but because the basic math demands it. This is where patience becomes an edge. Those who survive the flush benefit from the re-rating that follows. Those who sell at the point of maximum stress lock in losses while smart institutions prepare to accumulate. In the next chapter, we will examine the macro timeline, how long liquidity crises typically last, and why calendar effects often mark the vital turning point. Liquidity crunches are violent, but they are rarely long-lived. The system simply cannot tolerate extended deflation. Debt requires rising asset values to remain serviceable, and when those values fall too far, intervention becomes inevitable. This is why time matters as much as price during panic moments like this. Historically, the acute phase of liquidity stress lasts days or weeks, not months. In 2008, the most intense selling occurred over a short window before policy responses escalated. In 2020, the crash unfolded rapidly and reversed just as quickly once liquidity was restored. These events feel endless while they are happening, but they are compressed in true hindsight. The calendar plays a quiet but powerful role. End-of-year trading distorts behavior. Funds harvest tax losses. Risk is reduced. Liquidity thins out. This exaggerates moves in both directions. Once the calendar flips, those artificial pressures disappear. Sellers step away. Stacker buyers return. January is historically a reset point. Capital that was sidelined re-enters the market. Allocations are refreshed. Pullbacks that looked terrifying in December suddenly look like opportunity. This is why crashes near year-end often become the foundation for early-year spot rallies. Psychology reinforces this shift. Fear peaks after damage is done, not before. When sentiment flips from euphoria to despair in a matter of days, the market is already closer to a low than a high. Most participants react late. The market actually anticipates. We are approaching that inflection window. Spot price alone will not signal it. Behavior will. Reduced volatility, stabilization, and selective buying are the clues. The final chapter will bring this together, outlining the strategic lessons, risk management principles, and the mindset required to navigate what comes next. We have now dissected this event from every angle. The mechanics of forced liquidation, the role of gold as collateral, the algorithmic cascade, the divergence between paper price and physical reality. What remains is the lesson because every liquidity crisis leaves one behind us. The market did not fail today. It revealed itself. Leverage was exposed, excess was removed, sentiment was reset. This was not the end of a trend, but a stress test of conviction. Those who were overextended were removed. Those who relied on borrowed time were forced right out. The strategic takeaway is simple but unforgiving. Survival comes first. Leverage is the enemy in volatile markets. If you own real assets without margin, time is your ally. If you rely on borrowed money, time works against you. Liquidity events do not reward intelligence. They reward true positioning. The second lesson is patience. Markets that fall the hardest in liquidity crises are often the same markets that lead the recovery. Once intervention begins and cash returns, capital flows back into assets that were unfairly punished. This is not optimism. It is just pattern recognition. The third lesson is psychological discipline. The greatest damage is rarely financial. It is emotional. Anchoring to recent highs, reacting to fear, and confusing volatility with failure are how investors destroy long-term outcomes. The macro trend matters more than the day. What comes next will not be smooth. Volatility will persist. Tests will occur. But liquidity always returns. When it does, the narrative changes fast. Fear becomes disbelief. Disbelief becomes participation. Participation becomes excess. The cycle repeats again. Your role is not to predict every move. It is to remain solvent, rational, and prepared. This event did not invalidate the long-term thesis. It strongly reinforced it. If this analysis helped you stay grounded, take a moment to support the channel. Type 1 in the comments if you're still holding through the volatility. Type 2 if you're watching from the sidelines here. Subscribe, share this breakdown, and stay focused. The market will move on. Those who understand it will move along with it.